Stop for a second. Put your phone down, close those extra tabs, take a breath. Because what I'm about to lay out is not small, it's not noise, and it's not another wild internet rumor. This changes how you see the financial system. For years, people who believed in silver and gold were laughed at. You've seen it. The media called them paranoid. Bankers in expensive suits said silver was just a shiny rock. They said gold was outdated. They said the Federal Reserve had everything under control. Hello everyone, welcome to John A.G. Expert. My name is John, and I have over 10 years of hands-on experience in the silver and gold markets. On this channel, you'll get honest market analysis, clear price action insights, and practical trading and investment guidance. No hype, no false promises. If you're serious about silver and gold, you're in the right place. Don't forget to subscribe. And now, let's get back to the market update. We were told the market was fair. We were told prices were based on simple supply and demand. We were told powerful people didn't care about precious metals. That story just fell apart. Because now we have something different. Not just opinions, not just theories. We have documents, private conversations, emails that were never meant to see the light of day, and they tell a very different story. While the world has been distracted by wars, by oil prices, by celebrity scandals, a massive data release quietly hit the internet. Most people focused on the obvious headlines, political names, flight logs, scandals. But buried inside that data was something almost no one in financial media wants to talk about: money. It turns out Jeffrey Epstein and Ghislaine Maxwell were not just running in elite circles. They were managing wealth, serious wealth, for some of the richest and most connected people in the world. And when you look at what they were buying with that money, it confirms what many people have suspected for years about silver. Among the released emails are exchanges between Epstein, Maxwell, and a high-level French banker identified only as Bernard. The name itself isn't the point. The content is. These emails go back to the early 2010s, right after the 2008 financial crash. Around the same time, silver ran to nearly $50 an ounce before crashing back down. The public was told the silver bubble had popped. Investors were told to move on. The story was over. But behind closed doors, the tone was very different. In one email from late 2011, Bernard gives direct advice about where to place money. This wasn't public commentary. No TV cameras, no interviews. Just elite money managers speaking freely. And what did he recommend? Not treasury bonds, not the S&P 500, not trust in the dollar. He recommended silver, but not in the way most people think. He didn't say, buy it and hope it goes up. He said a price squeeze was possible if someone took full delivery of the futures contracts. That's a key detail. He wasn't talking about paper trading. He was talking about demanding the real metal, physical bars, real ounces. In simple terms, he believed the silver market was stretched thin, that there were far more paper claims to silver than actual silver sitting in vaults. And if a large player demanded delivery instead of settling for cash, the system could crack. He saw weakness. He believed the structure itself was fragile. And then came the price target. Remember, this was after silver fell from $50 down into the $30 range. The public mood was negative. The media was dismissive. But privately, Bernard suggested silver could reach $60 without heavy speculation. And more importantly, he estimated its true inflation-adjusted value around $150, $150. That was 2011. Let that sink in. While everyday investors were told silver was finished, powerful insiders were quietly discussing triple-digit valuations as fair value. They believed inflation was understated. They believed official numbers didn't reflect reality. And they believed silver's real price was being suppressed by the paper market structure. Now, fast forward. Think about how much money has been printed since 2011, trillions during the pandemic, massive debt increases, stimulus after stimulus. If $150 was considered fair value back then, what does that imply today? That's the question no one on television is asking, and they didn't just talk about it. Trade records show large purchases were actually made. Mining companies, physical exposure, strategic positioning. This wasn't theory, it was action. They weren't buying for decoration. They weren't buying because silver looked pretty. They were positioning against the financial system itself. That destroys the old stereotype, the idea that only fringe investors care about precious metals. The document suggests that some of the most connected people on the planet were thinking the same way. Not because they were scared of headlines, but because they understood how leverage works, how debt compounds, how paper systems can fail. The deeper message inside those emails wasn't just about silver's price, it was about power. Real power is not just influence or secrets, it's independence. If your wealth exists entirely inside banks, it can be frozen. If it exists inside digital accounts, it can be restricted. Physical assets are different. They sit outside that system. That's what makes this so important. The insiders were preparing for a moment when the music stops, when paper promises get tested, and they wanted metal in hand when that happened. But here's where it gets even more interesting. The emails also mentioned the gold-to-silver ratio dropping sharply. In basic terms, that would mean silver outperforming gold by a wide margin. At the time, that sounded extreme. Today, it doesn't sound so crazy. Because what they described back then, the squeeze, the delivery stress, the imbalance between paper and physical, is starting to show up in real markets right now. And that's where this story moves from old emails to breaking news happening today. Because while those private conversations were predicting a delivery crisis years ago, one of the largest silver markets in the world just made a move that confirms physical supply is getting tight. We need to talk about Shanghai. But before we go there, pause for a moment and think about what we just covered. 15 years ago, insiders believed silver's real value was far higher than market price. They believed the paper system was fragile. They believed delivery was the pressure point. Now ask yourself, what happens if that pressure point is finally being tested? Now, let's move from old emails to what is happening right now. Because while those private messages were predicting a silver squeeze years ago, something major just happened in China. And it's not a rumor. It's an official rule change. On February 11, 2026, the Shanghai Futures Exchange, one of the largest physical silver markets in the world, posted a new policy. It was buried in technical language. Easy to miss, easy to ignore, but the meaning is simple. Starting February 28th, any trader who does not have a government-approved hedging quota will receive 0 lots in delivery. 0. Not delayed, not reduced, not partial. 0. Let's break that down in plain English. If you are a normal investor in China and you buy a silver futures contract expecting to take delivery of physical metal, you now get nothing. You will be forced to settle in cash. You paid for silver, you get paper. That's not a small change. That's a locked door. In a healthy free market, if supply gets tight, the price rises. Higher prices encourage sellers to step in. That's how shortages normally get solved. But this is different. Instead of allowing price to rise freely, the exchange changed the rules. They restricted who is allowed to take delivery. Only certain large industrial players with government approval can access the physical silver. Everyone else? Out. That's not a functioning free market. That's rationing. And you only ration something when it's running low. You don't ration sand in the desert. You don't ration water in the ocean. You ration things that are scarce and critical. Silver is critical. It's used in solar panels, electronics, electric vehicles, military systems, medical equipment. Modern industry cannot function without it. So what does this rule change really tell us? It tells us that physical silver inside China is tight enough that authorities don't want it leaving the system. They are prioritizing factories and state-linked industries over private investors. That's a huge signal, because Shanghai has historically been one of the places where real metal moves. Unlike some Western exchanges where most contracts settle in cash, Shanghai has been known for stronger physical delivery, and now they're saying, we can't let everyone take metal anymore. Think about what that means psychologically. Imagine you're a wealthy investor in Shanghai. You see the government effectively closing access to physical silver. What's your reaction? You don't relax, you panic. If you can't get silver through official channels, you look elsewhere. You turn to jewelry markets, private dealers, underground supply chains. When governments restrict access, demand doesn't disappear, it shifts. We're already seeing reports of higher premiums for physical silver inside China's informal markets. When official doors close, the price outside those doors often rises fast. Now, zoom out. China is the world's second-largest economy. It's a major manufacturing hub. If physical silver is tight there, it affects the entire global supply chain. If they can't easily source silver domestically, they will import more aggressively. They will pull metal from global vaults to feed their industries. That creates pressure elsewhere. In London, in New York, in Zurich, markets are connected. If one major player starts pulling harder on supply, everyone feels it. Now remember what those emails from 2011 suggested. A squeeze happens when someone demands delivery instead of settling for cash. Shanghai's new rule is basically saying we cannot allow open delivery anymore. That's not confidence, that's stress. And here's the uncomfortable question. If one major exchange can restrict delivery with the stroke of a pen, what stops others from doing the same? Do you think Western exchanges would hesitate if industrial supply chains were at risk? History says they would protect strategic industries first. Retail investors would not be the priority. So now we have two powerful pieces of this puzzle. Private emails from insiders years ago describing a fragile paper system, a major global exchange today restricting access to physical metal. That's not theory anymore. That's action. But the story doesn't stop in China, because while Beijing is locking down supply and protecting industry, another country is doing the opposite. They are not rationing. They are buying aggressively. And their demand is so large, it may be reshaping the entire global balance of supply and demand. We need to talk about India. While China is locking the vault doors, India is doing the opposite. They're not restricting silver. They're stacking it. And the numbers are not small. They're massive. In January 2026 alone, Indian silver ETFs added about 13.5 million ounces of physical silver. That's in just 1 month. To give you perspective, that's over 400 tons of metal. And that's only what went into ETFs, not counting jewelry, silverware, coins, or private cash deals happening in local markets. Now here's what makes this even more important. January wasn't some random spike. The month before, in December 2025, Indian investors added roughly 23 million ounces. Add those 2 months together. That's about 36.5 million ounces of silver removed from global supply in just 60 days. Let that sink in. Global mining production is around 800 million ounces per year. That means in 2 months, India alone absorbed nearly 5% of the world's annual supply. And that's just the investment side. And unlike some Western paper products, Indian silver ETFs are required to hold physical metal. When investors buy shares, real bars must be stored in vaults. That means silver actually moves. It doesn't just sit as a digital number on a screen. Bars leave London. Bars leave New York. Bars get allocated and shipped. The physical system gets tighter. Now ask the obvious question. Why is India buying so aggressively? The answer is simple. They understand currency risk. In the West, when silver drops from $120 to $80, many investors panic. They think something is wrong. They sell. In India, price drops are seen differently. They see discounts. Silver and gold are deeply rooted in Indian culture. For many families, precious metals are not speculation. They are savings. They are security. Paper currency comes and goes. Governments change policies. Inflation eats purchasing power. Metal holds value across generations. And right now, inflation is not just an American problem, it's global. People everywhere feel their savings shrinking. India's middle class is growing. Millions of people are earning more money than ever before. And instead of trusting only banks or government promises, many are choosing hard assets. On top of that, India's industrial demand is rising fast. They're expanding solar energy. They're building electronics factories. They're positioning themselves as an alternative manufacturing hub as companies diversify away from China. Solar panels alone require large amounts of silver, so India has two forces pushing demand at the same time. Investment demand from households and institutions. Industrial demand from factories and energy projects. That combination is powerful. Now, step back and look at the bigger picture. On one side, China is rationing silver because supply is tight. On the other side, India is absorbing millions of ounces every month. And in the middle? Western exchanges like COMEX and the LBMA are setting a price that still suggests silver is abundant. That tension cannot last forever. You cannot have two of the largest populations on Earth competing for a limited resource while the price says there's plenty to go around. At some point, something gives. And here's where it connects back to those old emails. Remember the idea. A squeeze happens when someone demands full delivery. The banker assumed it would take one billionaire. But what if it's not one person? What if it's a country? India, in effect, is acting like a giant whale. Millions of investors making small purchases add up to enormous physical demand. No drama, no conspiracy, just steady buying. And every ounce that leaves a vault reduces flexibility in the system. That's the part many people miss. Paper markets can expand almost endlessly. More contracts, more leverage, more digital claims. But physical metal is finite. When enough physical leaves the system, the paper structure starts to strain. Now combine that with what we just saw in Shanghai. China restricts delivery. India absorbs supply. If both trends continue, Western vaults feel the pressure. And if delivery stress spreads from east to west, rule changes don't stay local. That's when markets get volatile. That's when price moves stop being gradual. Because when supply is tight and demand stays strong, price eventually adjusts, sometimes very fast. But before we talk about where price could go, we need to zoom out, way out, because there's something forming on long-term charts that very few people are discussing publicly. And if it plays out the way history suggests, we may not be talking about $150 silver. We may be talking about something much larger. Now let's zoom out. Not to the 1-minute chart, not to daily price swings, not to whether silver is $80 or $72 this week. Zoom out 45 years, because when you do, something big appears. In 1980, silver spiked near $50. That was a historic high at the time. Then came a long decline, decades of sideways action, long stretches where silver went nowhere. Most people lost interest. Then in 2011, silver ran back to around $50 again. That created something powerful on the long-term chart. Technical analysts call it a cup and handle pattern. It's a slow, rounded base that forms over many years, followed by a consolidation phase. When that kind of pattern breaks out, the move that follows can be strong. And this one didn't form over months. It formed over decades. 1980 to 2011 created the large cup. 2011 to now has formed the handle. That's more than 40 years of pressure building. When patterns take that long to develop, the breakout, if it truly happens, tends to be large. Now let's be realistic. No price moves in a straight line. Markets shake people out. We just saw silver surge above $100 and then pull back hard. That volatility scares people. But history shows that big bull markets often include violent corrections before the real acceleration. Look back at gold in the 1970s. It ran up strongly. Then it crashed 50% in the middle of the move. Many thought it was over. It wasn't. After that crash, gold surged to new highs in a powerful final phase. Silver could follow a similar path, not because of hype, not because of social media, but because of math. Supply is limited. Industrial demand is rising. Investment demand in Asia is strong. And exchanges are starting to show stress. If the long-term pattern breaks cleanly, technical targets are not $100. Some conservative projections land around $300. If you adjust for inflation from 1980, even higher levels are possible. Now that doesn't mean tomorrow. It doesn't mean next week. Markets move in waves. But when physical supply gets tight and demand stays strong, price doesn't drift slowly upward forever. At some point, it jumps to a new level to rebalance. And here's the key part. When Shanghai restricted delivery, they showed something important. Rules can change fast. One announcement, one update, and suddenly access is limited. If a major Western exchange faced similar delivery stress, do you think they would hesitate to protect large industries first? Governments protect what they see as critical. Retail investors are rarely first in line. That's not fear, that's history. So what does this all add up to? 15 years ago, insiders privately discussed silver's higher true value. Today, China is rationing delivery. India is absorbing millions of ounces monthly. Long-term charts show decades of consolidation, and the paper price still trades far below what many believe is fair value. That gap between price and perceived value is where opportunity lives. But opportunities don't stay open forever. If delivery restrictions spread, access could tighten quickly. If industrial demand keeps rising, inventory buffers shrink. If investment demand stays strong in Asia, Western vaults feel pressure. The squeeze isn't a meme. It isn't a message board idea. It's simply what happens when physical demand meets limited supply. So the real question isn't whether silver can be volatile. It always will be. The real question is this. When physical access tightens further, not if, but when, will you already have your position set? Or will you be trying to buy after doors start closing? Right now, the screen may say $80, but markets don't stay disconnected from reality forever. At some point, paper promises meet physical limits, and when that adjustment happens, it rarely sends out a polite warning first.